Hello, my name is Paul Walters and I lead our firm's Asia Pacific Real Estate Assurance Practice. I'm very pleased to announce the launch of Real Estate 2020, Building the Future. This is our firm's new thought leadership piece for the real estate sector. This report aims at looking at the changing landscape of our sector in the next 6 years and beyond.
The urbanization ratio of China is at 54%. That's an urban population of almost 736 million people, with a projected annual increase of just over 1%. That's over 15 million people each year moving into urban areas. This leads to the rise in density of the main cities, which will in turn drive the population to a smaller city and satellite cities.
We will have a Tokyo Olympic in 2020. And actually, 50 years ago, we had a first Tokyo Olympic, and we constructed a huge infrastructure like a Shinkansen, bullet train, and Tokyo Metropolitan Highway. And it's now time to reconstruct those huge infrastructures. Now we have a very strong reason to make a huge investment in Tokyo. So this investment is investment for the future. So we had a great opportunity with the Tokyo Olympic in 2020.
In Hong Kong, previous generations had planned to retire in China, where it was much cheaper. However, with massive inflation and the cost of living over the last 15 years, this may no longer be practical, and Hong Kong people may need to live in Hong Kong, and the Hong Kong government must be able to provide increased growth for its elderly that it thought first was going to live in China.
It is expected that the urban household income in China will be at least doubled in the next 8 to 10 years. We expect to see this evolution of the middle class will create growth in the discretionary spending and demand for premium quality goods and services, including education, recreation, and of course accommodation.
Well, there's a couple of observable trends, I guess, in terms of Chinese investment. The main two have been that they're willing to take on a lot of development risk, particularly in the residential sector. They know best the demand back at home for investment in Australian real estate, and they're really prepared to take on risk and construct residential developments from scratch. The other trend that we're starting to see is them buying up B-grade office buildings and convert those into, into residential dwelling for sale back in China.
If we just look at Indonesia and Myanmar, we think that there's significant opportunity because of their population growth and because of their plans to become the vibrant city in the next 6 to 10 years. So I would think from an investor's perspective, they will be chasing real estate in those countries.
Towards 2020, competition for real estate assets will become increasingly intense, especially in emerging markets such as China. Foreign asset managers may seek to collaborate with the locals through joint ventures, mergers and acquisitions, or otherwise recruit and groom the local talents.
A number of governments in the region are introducing carbon pricing or carbon trading. Tokyo was the first city to introduce a citywide cap and trade system which includes the building sector. In China, what they're doing is they've introduced a number of cap and trade systems as pilots, but typically in the industrial sectors. If the Chinese government decides to expand this to the building sector, that's going to be a major driver for green buildings in the region.
Well, really the demand for green buildings has been tenant-driven, and there's two real reasons for that in Australia. The first is the price of utilities. We've seen an enormous increase in the price of electricity, the price of water in Australia over the last few years. And tenants are starting to realise that the greener the building, the lower the utility cost they bear. So there's a real practical imperative to build green buildings in this country. The other, I guess, is around employee engagement. And lots of the largest tenants in this country have undertakings with their employees as to their sustainability credentials. Shopping centres are therefore having to fill that space with something else, and increasingly the proposition for a shopping centre is it's actually a place of entertainment. So we're seeing more by way of services, cinemas, and restaurants in shopping centres.
I mean, with current day and age, most people just go into the internet platforms to make most of their purchases. The design of the buildings and the space allocation will be more towards experiential shopping, whereby you go and have a feel, and it's more for the retailers to display their products rather than for them to commit to a purchase.
I think sovereign wealth funds will move from a traditionally passive investment type of model to one whereby there's more strategic partnerships, especially with real estate players with localized knowledge.
Japan's government pension investment fund, which is a GPIF we call, that is managing more than 100 trillion yen, which is almost $1 trillion US fund. Currently zero exposure to the real estate market, but they are thinking about start investment in real estate, and they started research. So even if just 1% of their asset is allocated to Japan real estate, that will have a huge impact on Japanese real estate market.